From complexity to simplicity, Qiu Guolu teaches you to grasp the essence of investing. Simple path to investing. Why does investing seem complex, yet some people make fortunes with simple methods? In the noisy stock market, Qiu Guolu's The Simple Things in Investing is like a beacon, guiding ordinary investors through the fog to find the path to wealth growth. This book isn't a dense pile of theories but a distillation of the essence of value investing, based on the author's over 20 years of experience. Qiu Guolu, a top-tier Chinese fund manager, once managed tens of billions in assets, navigating multiple bull and bear market cycles in China. He proposes that the essence of investing isn't chasing trends or predicting price movements but returning to common sense, buying good companies at good prices and waiting for the right timing. This simplicity over complexity philosophy stems from his deep understanding and proven practice of value investing. Whether it was the 1998 Asian financial crisis or the 2008 global financial meltdown, Qiu Guolu stayed rational, leading his team to steady returns amid turmoil. His core belief is that investing doesn't require complex models or advanced math. Just grasping a company's intrinsic value can simplify the process and make you invincible. Why do simple methods often work better? Qiu Guolu believes market complexity arises from human nature. Greed, fear, and short-sightedness lead investors astray. He cites Kweichow Moutai, noting that this liquor giant was undervalued at its 2003 IPO, but through long-term holding, its value shone, with its stock price soaring from 30 yuan to over 1,000 yuan, yielding an annualized return exceeding 20%. This case reveals the power of simple investing: find quality companies and patiently wait for market recognition. Qiu Guolu's wisdom comes not just from books but from his deep insights into the Chinese market. He once said, "The simplest thing in investing is finding a good company and growing with it." This statement captures the soul of the book, using common sense and patience to overcome market noise. Why does investing need simplicity? Qiu Guolu explains that information overload and emotional swings often render complex strategies ineffective. He mentions Edward Smith, a British investor who, post-2009 financial crisis, studied the consumer goods sector and bought Unilever. Relying on its brand strength and global supply chain, Unilever's stock doubled in 5 years. Edward's success didn't come from high-frequency trading or complex algorithms but from focusing on business fundamentals and adhering to simple value investing principles. Qiu Guolu stresses that simplicity doesn't mean shallowness. It's the result of deep research distilled into clarity, reflecting a profound understanding of market essence. This chapter introduces you to Qiu Guolu's investment world, exploring how he extracts simplicity from a complex market. The following chapters will break down the book's core ideas across 6 dimensions: philosophy, methods, mindset, industry selection, risk control, and Chinese market characteristics, helping you build your own investment framework. The foundation of value investing. Value investing isn't a novel concept, but Qiu Guolu's practice breathes new life into it. His investment philosophy is heavily influenced by Benjamin Graham and Warren Buffett, yet tailored to the Chinese market. Qiu Guolu writes in the book, "Buying a stock is buying a piece of a company." This simple idea shifts how many view stocks not as numbers in a game but as a rational judgment of a company's future cash flows. Qiu Guolu's career vividly illustrates this philosophy. Early on Wall Street, he studied Graham's security analysis, learning to evaluate company value with a margin of safety. Back in China, managing Southern Fund, he faced the high volatility of the Chinese stock market but stuck to focusing on business fundamentals, avoiding short-term speculative stocks. During the 2008 financial crisis, he led his team to heavily invest in consumer goods leaders like Wuliangi and Hengrui Electric, which demonstrated strong profitability and resilience, proving the universal applicability of value investing. Qiu Guolu recalls that despite widespread market pessimism, he analyzed companies' financial statements and industry positions, concluding they were severely undervalued, ultimately yielding excess returns. Value investing hinges on 2 points: understanding a company's intrinsic value and buying it at a discount. Qiu Guolu uses the moat concept to explain how to identify good companies. He cites Coca-Cola, which, with its brand loyalty and global distribution network, built an unshakable competitive edge. Similarly, in China, he sees opportunities in consumption upgrades, like liquor, pharmaceuticals, and appliances, where leading companies often have stable cash flows and market share. For example, Yunnan with its unique product formula and brand trust, has maintained high gross margins for years, making it a value investing exemplar. To estimate intrinsic value. Qiu Guolu suggests investors focus on a company's profitability, growth potential, and risk exposure, not short-term price swings. He shares the story of James Carter, a London-based private investor who in 2015 noticed Apple's stock dip due to iPhone sales concerns. By analyzing Apple's cash flow, R&D investment, and brand premium, James judged its intrinsic value far exceeded its market price and bought in. 5 years later, Apple's stock doubled, earning him significant profits. James's success wasn't luck. He spent months studying Apple's financials, noting its R&D spending exceeded $10 billion annually, ensuring product competitiveness. He also observed Apple's ecosystem, like the App Store and iCloud, created stable subscription revenue, enhancing cash flow certainty. James didn't stop at data. He researched Apple's supply chain, learning its close partnership with TSMC ensured chip technology leadership, solidifying his confidence. Qiu Guolu notes that value investing requires from financials to fieldwork, and James's approach embodies this. Beyond financials, he used industry reports and consumer feedback to confirm Apple's unmatched global brand loyalty. This thorough research helped him stay calm amid market panic, reaping rich rewards. Qiu Guolu also cites Hengrui Medicine, a Chinese pharmaceutical company, to show this method works in China. In 2016, Hengrui's stock slumped due to slower drug approval processes, but by analyzing its R&D pipeline and patent portfolio, Qiu judged its long-term value and bought in, doubling his investment in 3 years. This inside-out research method is the core of value investing. The case shows that value investing demands deep company research, not following market sentiment. Qiu Guolu stresses that value investing isn't about chasing low prices but seeking value for money. He quotes Buffett, "It's better to buy a great company at a fair price than a mediocre one at a cheap price." This requires the ability to identify quality companies and maintain independent market judgment. He mentions a 2010 investment in a regional bank with a price-to-book ratio of just 0.8, where, by analyzing its asset quality and regional advantages, he saw long-term potential, and the stock tripled in 3 years. This buy good, not just cheap philosophy is the essence of value investing. Value investing also requires deep industry understanding. Qiu Guolu notes that different industries have different moats. Consumer goods rely on brands and channels, while tech depends on innovation and barriers. He cites Tencent, whose WeChat platform's network effect creates high user stickiness, forming a strong competitive barrier. Investors must analyze industries to find companies that can win long-term. 3 principles of stock selection. Qiu Guolu summarizes stock selection in 3 principles: good company, good price, good timing. All 3 are essential, forming the practical framework of value investing. A good company is the cornerstone of stock selection. Qiu Guolu believes a good company needs sustained profitability, a clear business model, and strong competitive advantages. He cites Kweichow Moutai, which grew during the 2008 financial crisis, leveraging its premium liquor brand and supply-demand imbalance, maintaining gross margins above 90%. He notes Moutai's success stems from its scarcity. Unique brewing techniques and geographic conditions are hard to replicate. Similarly, Tencent's WeChat ecosystem, with its network effect, makes it a long-term winner in China. How to identify good companies. Qiu suggests 3 dimensions: financial health, industry position, and management quality. Financial health requires stable cash flows and low debt, like Haitian flavoring, with net margins consistently above 20%. Industry position looks at a company's influence in its value chain, like Cattle's dominance in EV batteries. Management quality hinges on the strategic vision and execution of leadership, as seen in Media Group's global transformation from appliance maker to tech firm. A good price is the lifeline of value investing. Qiu Guolu stresses that buying price determines returns. Even great companies at overvalued prices can lead to losses. He recalls the 2015 Chinese stock market bubble, where many tech stocks had price-to-earnings ratios over 100, far exceeding reasonable levels. He cites Gree Electric, whose PRE ratio dropped to 6 in 2013, well below the industry average, prompting him to buy, and the stock doubled the next year. Qiu suggests using metrics like P or E and P or B combined with industry traits to judge if a stock is cheap. He also mentions the discounted cash flow DCF model, though complex, as more precise for valuing growth companies. Good timing is the cherry on top. Qiu Guolu believes market volatility offers chances to buy low. He recalls the 2008 financial crisis when panic led to undervalued quality stocks, and he seized the opportunity to buy consumer goods, earning excess returns. Similarly, Maria Gonzalez, a Spanish investor, bought undervalued Pfizer in early 2020 during the pandemic, and with its vaccine success, the stock rose 50% in 2 years. Maria's case highlights the nuance of good timing. She didn't just wait for a market bottom but acted early in the pandemic, spotting industry trends. She noted surging global vaccine demand and Pfizer's strong R&D and production network. Analyzing Pfizer's financials, she found its R&D spending was 15% of revenue, above the industry average, signaling vaccine leadership. Maria also studied Pfizer's partnership with BioNTech, confirming the promise of Myrna technology, which gave her confidence to buy amid market pessimism. Qiu Guolu emphasizes that good timing isn't just low prices but moments when a company's value and market sentiment misalign. He cites BYD, a Chinese EV maker, whose stock dipped in 2020 due to the pandemic, but by analyzing its battery tech and policy support, he saw long-term potential and bought, tripling his investment in 2 years. Qiu suggests capturing good timing requires combining macro trends and micro research, like tracking policy shifts, industry turning points, and company catalysts. Maria's success also stemmed from discipline. She set clear profit-taking goals, avoiding greed-driven mistakes. This precise timing is the bridge from value investing theory to practice. Qiu Guolu notes that good timing often emerges during extreme market pessimism or exuberance, where contrarian thinking is key. He cites Yili Group, whose stock slumped in 2014 due to a dairy crisis, but by analyzing its national expansion and brand strength, he saw long-term value and bought, doubling his investment in 3 years. He stresses that stock selection isn't just technical analysis but a blend of logic and patience. Investors must act like detectives, uncovering a company's true value and waiting for the market to offer a fair price. The market's irrational traps. The market isn't a rational machine but a magnifier of human nature. Qiu Guolu deeply analyzes the market's irrational behaviors, noting that greed, fear, and short-sightedness often trap investors. He draws on behavioral finance to highlight dangers like herd mentality, anchoring bias, and overtrading. Herd mentality drives blind trend chasing. He recalls the 2015 Chinese stock market frenzy over Internet Plus concepts, where companies merely adding tech to their names saw stock prices soar, only to crash when the bubble burst. He cites Lico, whose stock surged in 2015 on its ecosystem concept but collapsed due to weak fundamentals. He advises staying independent and avoiding market hypes, like Buffett did in 2000, dodging the dot-com bubble by sticking to traditional industries. Anchoring bias misleads investors with past prices. Qiu gives an example of an investor hesitant to buy a stock that fell from 100 yuans to 50 yuans, ignoring that its intrinsic value exceeded the current price. He cites Willie Angie, whose stock crashed in 2012 due to a plasticizer scandal, but with unchanged fundamentals, he bought and doubled his investment the next year. London investor Alan Brown had a similar experience, hesitating over Apple's 2018 high but, after analyzing its cash flow and innovation, bought at a low, earning significant profits. Qiu suggests focusing on intrinsic value, not historical prices. Overtrading is another trap. Qiu cites studies showing frequent traders' annualized returns lag market indices by 3–5 percentage points. He believes overtrading stems from obsessing over short-term swings, while value investing emphasizes long-term holding. He shares his 2010 investment in an appliance company, holding for 5 years to achieve over 300% returns, while peers chasing short-term gains lost out. He also mentions Anna Schmidt, a German investor who bought Siemens in 2016 and by holding long-term, earned 70% returns in 5 years, while her overtrading colleagues lost to market swings. Anna's success shows overcoming irrational traps requires strong mental discipline. She set clear rules, invest only in companies she understood, review quarterly, and avoid reacting to short-term swings. Qiu Guolu notes that market irrationality often stems from information asymmetry and emotional amplification, requiring systematic learning to build confidence. Cites a 2017 Chinese blockchain stock that surged tenfold on hype but crashed due to weak fundamentals, and avoided such traps by analyzing Siemens' industrial automation business, confirming its long-term edge in smart manufacturing, resisting tech stock mania. Qiu suggests creating a mental account, treating investing as a long-term endeavor, not a short-term gamble. He mentions Chinese investor Wang Zihua, who, in 2018, held a retail stock for 3 years despite fluctuations, doubling his investment by focusing on its national expansion. Qiu emphasizes that mental lies in focusing on long-term value, not short-term noise. This mindset requires practice and reflection to develop. Qiu advises investors to read financial reports and track industry trends to build deep company understanding, shielding against market emotions. He quotes Buffett, "If you wouldn't hold a stock for 10 years, don't hold it for 10 minutes." This reminds us that market irrationality is normal, and only rational thinking stands out. He also stresses building an investment system, like setting clear buy and sell criteria, to avoid being swayed by market emotions. The art of industry selection. Choosing the right industry is a critical step to investment success. Qiu Guolu notes that industry traits determine a company's growth potential and profitability, requiring investors to understand competitive landscapes and long-term trends to find true gold mines. He divides industries into 3 types: high growth, stable, and cyclical, each with unique investment logic. High growth industries, tied to tech innovation or consumption upgrades, offer huge potential but high risks. Qiu cites the renewable energy sector, where cattle became a global leader by 2018 due to its advanced battery technology. He notes that renewable energy's growth stems from policy support and energy transitions, but high valuations and competition require caution. He advises focusing on industry leaders' moats like cattle's patents and supply chain edge. Swedish investor Carl Lindberg bought Tesla in 2020, leveraging its brand and tech leadership, doubling his investment in 3 years. Stable industries are fertile ground for value investing, with steady cash flows and strong risk resistance. Qiu favors consumer goods like liquor, food, and pharmaceuticals. He cites Haitian flavoring, a condiment leader with brand and channel strength, maintaining over 20% net margins for years. Notes stable industries often have high entry barriers, ideal for long-term holding. For example, in 2015, he invested in a pharmaceutical company with exclusive drugs and high margins, earning 200% returns in 5 years. Qiu suggests focusing on brand strength and market share in stable industries. Cyclical industries require timing the rhythm. Qiu cites real estate, where loose policies in 2009 drove price surges, but tightening in 2014 led to a slump. He advises buying at cycle lows, like his 2012 investment in a cement company that doubled the next year due to infrastructure recovery. He mentions Chinese investor Liang Zhou, who studied the non-ferrous metals sector in 2016, buying Zijin Mining at a low, profiting handsomely as metal prices rebounded. Liang's success came from understanding cyclical industries. He studied global commodity supply-demand, noting supply contraction from environmental policies and rising copper demand from renewables. By analyzing Zijin Mining's reserves and cost advantages, he saw it would benefit in a cycle upturn. He notes that cyclical investing requires catching supply-demand turning points and assessing cost control. He cites China's steel industry, where 2016 supply-side reforms drove steel prices up, boosting base steel stock by 80% in 2 years. Qiu advises tracking macro indicators like PMI, inventory levels, and policy shifts, alongside micro-company strengths. He mentions Portuguese investor Isabel Ferreira, who studied global shipping in 2019, buying Maersk as container rates recovered, earning 60% returns in 2 years. Qiu emphasizes that cyclical opportunities hide in overlooked low points, requiring a cross-cycle perspective to spot supply-demand imbalances. He warns that cyclical industries' volatility demands clear exit strategies to avoid buying at peaks. Liang's case proves that with industry insight and company strengths, cyclical industries can be value investing gold mines. Qiu stresses that industry selection requires blending macro trends and micro analysis. He advises focusing on 3 demographics, policy, and technological change. For example, China's aging population fuels pharmaceutical growth, while digital transformation drives cloud computing and AI opportunities. He quotes an old saying, "Those who understand the times are the wise." Investors must align with industry trends and deeply study company advantages to find winners in the right race. The wisdom of risk control. Investing isn't just about returns, it's about managing risks. Qiu Guolu repeatedly stresses that risk control is the lifeline of value investing. Be it market swings, industry shifts, or company missteps, investors need a systematic risk management framework. Diversification is the foundation of risk reduction. Qiu suggests ordinary investors hold 10-15 stocks across different industries to avoid putting all eggs in one basket. He cites 2008 when he diversified into consumer goods, pharmaceuticals, and finance, maintaining positive returns despite market declines. British investor Susan Hall, in 2019, diversified across European retail, energy, and tech, weathering the pandemic with an 8% annualized return. The margin of safety is key to handling uncertainty. Qiu, echoing Graham, stresses buying at prices well below intrinsic value to buffer unexpected risks. He cites China Merchants Bank, whose stock fell to a 0.9 price-to-book ratio in 2013 due to bad debt fears, but after analyzing its asset quality and retail banking strategy, he bought, earning 50% returns in 2 years. Qiu suggests using metrics like P/E and dividend yield to quantify the margin of safety. Dynamic adjustment is crucial for market changes. Qiu believes investing isn't set and forget adjust positions based on company and industry shifts. In 2017, a liquor company's stock dipped due to management changes, but after confirming its fundamentals were intact, he added to his position, doubling his investment the next year. He shares the case of American investor John Davis, who held Amazon in 2018 but reduced it due to high valuations, shifting to undervalued Walmart, achieving a 60% portfolio return in 3 years. Qiu warns that risks come not just from markets but from investors' emotions and biases. He suggests keeping an investment journal to record trade logic and outcomes, aiding error reflection. He quotes a Western proverb, "Risk is not knowing what you're doing." Investors must learn and practice to sharpen risk awareness and control. The sublimation of simple investing wisdom. What is the ultimate wisdom of investing? Qiu Guolu sums it up in one word: simplicity, simple methods, simple thinking, simple mindset. He believes investment success lies not in complex technical analysis but in returning to common sense, finding good companies, buying at good prices, and waiting patiently for good timing. This simplicity applies not just to markets but to life. Qiu shares 4 lessons from his career: stay rational and avoid market noise. Focus on long-term value, ignoring short-term swings. Keep learning to deepen company and industry understanding, and maintain discipline to counter human weaknesses. He cites Kweichow Moutai's long-term growth bot in 2003, held for nearly 20 years, yielding over 50x returns. This success came from sticking to simple logic: pick great companies and grow with them. He also cites Buffett, who bought $1 billion of Coca-Cola in 1988, growing to $20 billion in 30 years, with a 12% annualized return. Buffett's success also stems from simplicity, focusing on his circle of competence, buying quality companies, and holding long-term. Qiu emphasizes that ordinary investors don't need Buffett's scale but can adopt his mindset using basic common sense to tackle complex markets. In the epilogue, Qiu encourages ordinary investors to let go of complex models and return to basic principles. He mentions Zhang Chen, a Chinese investor who, in 2015, embraced value investing, shunning speculative stocks and focusing on consumer goods and pharmaceuticals, doubling his assets in 5 years. He quotes Buffett, "Investing is like rolling a snowball. Find wet snow and a long hill, and you'll roll a big snowball." This captures the essence of simple investing: choose the right path and keep accumulating. Whether novice or veteran, by following the principles of good companies, good prices, and good timing, you can find your wealth path amid market ups and downs. Qiu Guolu writes, "The simplest thing in investing is using the most basic common sense to conquer the most complex markets." May every listener find their own simple path in the investment journey, reaping both wealth and wisdom.